Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is an oil and natural gas expert. He has worked different jobs in the oil and natural gas industry for decades, including as a former senior executive at Hess Oil, and he is currently the president of the Energy Prospectus Group, a networking organization based in Houston, Texas, that looks for good investments in the publicly traded oil and natural gas space. Dan Steffens, thank you for joining me again.
Yeah, Jason, great to be back.
So, Dan, there's a lot to talk about in oil and natural gas. It seems like there's bad policy after bad policy coming out basically every single day now from governments in the United States, the United Kingdom, the European Union. The CEO of ExxonMobil just said that he sees the global oil market having tight supply for the next 5 or so years. Do you agree with his assessment?
Yeah, I don't know about 5 or 6 years, but I could tell you there's no quick fix for this energy crisis, which is a totally man-made energy crisis. Anybody could have seen this coming. We didn't do enough investing in exploration and development during the pandemic, and mainly because we're under constant pressure from our own government, and who tells us they're going to, destroy the oil and gas industry. And then here we sit with high gasoline prices and that are going to be around, and we're very likely going to see rationing of transportation fuel soon, and we could end up with some serious space heating fuel shortages, both, heating oil, propane, natural gas this coming winter. Everything looks really, really tight.
And then we have the Biden administration, and they're unloading the Strategic Petroleum Reserve. Not only that, are they dumping that to try to manipulate the oil price lower? And they've done that a number of times since November. So there's been large-scale dumping in the Strategic Petroleum Reserve. We're going to have to buy back that oil at much higher prices to refill the Strategic Petroleum Reserve. But then they're also shipping our oil, our diesel, our gasoline to the European Union, to their friends in Davos, instead of helping everyday Americans here with lower gasoline and diesel prices.
Yeah, when Russia first invaded Ukraine, I said, can we please stay out of this? Can we please let Europe solve their own problem? No, we jump right in the middle of it. And now the American taxpayers are paying for the extremely bad decisions made in Europe. They totally screwed up on all this wind and solar stuff. Wind and solar was not ready for prime time, could not meet their energy needs. And they shut down nuclear power plants, shut down all their coal-fired power plants. And here they sit. And I watched an interview from Germany this morning, and they are in serious trouble. Russia has really reduced the exports of natural gas to Germany and a lot of the other Eastern European countries. And they right now have almost no way to get enough natural gas in storage to meet space heating fuel demand this next winter. They literally are going to have to ration natural gas to maybe even homes for space heating. Boy, they could be burning furniture to survive this next winter if they have a cold winter. They had a cold winter last year, so it could happen.
And Germany doesn't have enough liquefied natural gas terminals to import the LNG inside Germany. So there are LNG terminals in other European countries, and there are pipelines or trucks. So they could pipe or truck the liquefied natural gas, turn it back into compressed natural gas, and then pipe it or truck it to Germany. But then that's going to add extra costs. So it's not going to be cheap natural gas.
Yeah, I just looked at the natural gas price for LNG delivered to Europe, and it was $41 an MMBTU. What our price is, $6.30 or something today. So, I mean, it's just insane. They're in a bidding war with Asia for LNG supplies, and you can bet it's gonna get a lot worse. I mean, they don't really have any natural gas shortages now. It's just that they already are projecting that their storage is going to be depleted or very quickly. And, they could be out of natural gas for space heating by the end of January or something, because their storage is not going to be adequate.
And we're recording this interview on Friday, June 24th, 2022. The WTI crude oil price is above $107 a barrel. It is down the last couple of weeks substantially. Mm-hmm. I think it's down like 3 or 4%. It's not down 20 or 30% like some of these oil and natural gas stocks, some of these small and medium-sized companies that are minting free cash flow. The natural gas price is still above 6. I mean, we're at really healthy prices for the industry, but a lot of these shares have sold off lately.
Oh yeah, they're not trading at these stocks are not trading at anything close to today's oil and gas prices. When I go to my valuation models, I can put in $65 oil, $3 gas, and you're still have a valuation above the current share price. We have a model portfolio called the Sweet 16 that I've put out for the last 15 years that I've been doing EPG. And it was up 132% last year. But that portfolio is trading as a group for under 2.5 times cash flow. That's insane. I mean, when I was at Hess, I worked in business development for the last couple of years at Hess. And if we found small cap public companies that we could buy for 6 times cash flow, they were on the top of our list. I mean, it was hard to find them. Now I can give you a list of 20 of them right now. And some of them trading for 2 or 3 times cash flow. It's really crazy.
And those companies have robust free cash flow at the current prices, even though oil and natural gas are down from the last month or so, right?
Yeah, there's still this misconception, a few years ago, when the bottom fell out of the oil price and, frankly, a lot of people lost billions of dollars for sure, when the pandemic started and the commodity prices crashed. But this concept is still out there. You can't make money in these shale plays. Let me tell you, these shale wells, these horizontal shale wells at today's prices, they cost $7, $8, $9 million to drill and complete. They are paying out in less than 5 or 6 months at these prices. They come on so strong that, once they're hooked at a pipeline and online, in their first couple months, some of these wells are generating $2 or $3 million of cash flow per month. It's just incredible. I mean, when I was at Hess, if we had wells pay out in 3 years, we thought they were good wells, and they don't. I was interviewed by a station on the West Coast, and they literally think that this guy interviewing me literally thought that horizontal wells in these shale plays were fully depleted after 2 years. I said, no. They're way down. I mean, their production may be down even 80%, but they're still flowing, and they've paid out like 3 times in the first 2 years, and they're still making 100, 150 barrels a day. Multiply that by $100, and it's still a really profitable well at that point. And the operating expenses on these things, they're not even $10 to operate them. So they have a 90% profit margin on their production. So these shale companies now, and a lot of them are starting to pay really good dividends too.
So do you expect then a lot of mergers and acquisitions to pick up with some of these small and medium-sized companies? They're going to get taken out, especially the ones that are cash flowing, that have free cash flow in the next 6-12 months, if this valuation discrepancy. Because if you're a large company like Hess Oil, which has a $32 billion market cap, or you're a low-cost producer like EOG or Chevron, you want to go replace reserves. You have all this cash. You've raised dividends already. You've done share buybacks. You're going to go look to make mergers and acquisitions if you can buy free cash flow or cash flows at such low multiples.
Yeah, there's going to be some stuff. And another thing that there's going to be is some of these companies going private. You see that Continental Resources now, Harold Hamm, the founder of the company, he's made a proposal to take the company private. He said, why do I want to be public and put up with all this ESG type nonsense, and all these reporting requirements of being public when I could be private? He made a $70 per share offer. He already controls 83% of the stock. His family has 83% of stock. So for the other 17%, but it's still a multi-billion-dollar deal. The company has a 30-something billion-dollar market cap. I was just looking at Centennial today. They announced a big merger with a private company called Colgate, and it's going to create a company with 150,000 barrels a day of production when the merger closes, and they're going to be generating from day one incredible cash flow. It's existing companies, both of them. So they're going to get some synergies out of the merger, reducing overhead and stuff for each of them. And then they're going to generate a lot of cash flow, and have already announced they're going to be paying big variable dividends and a stock repurchase program and everything already. So the landscape's changing, and they've learned to live without debt. They've learned to live without having to tap into Wall Street for debt and equity capital because they're generating so much free cash flow. I've never seen, and I've been doing this really EPG for like 20 years. I did not originally found it. I just took over at 100% in 2006. But I've never seen so many companies generating free cash flow now in this group and cleaning up their balance sheets like crazy.
Yeah, these companies are a lot leaner and meaner than I've ever seen. And I've been covering oil stocks for many, many years now, around a decade.
Yeah, it's really good. I mean, there's going to be a lot of volatility. It scares people because it's going to be a wild ride. I mean, I said today, you got fear of the Fed. But one thing, these companies they're not really exposed to higher interest expense as much as they used to. And a lot of their debt now that they still have, it's just locked in. Those interest rates are locked in at what they issued that debt at. So their interest rates are not going up. They don't have to tap their bank credit lines anymore. More and more companies have paid off all their their bank credit lines, and they may have some senior debt, but that's pretty much locked in low interest rates already. And with what's going on in Russia, what's going on, OPEC Plus is totally tapped out of any spare capacity. The last time OPEC Plus had this little spare capacity, that's when oil went to 147. And if you did, inflation adjusted that, man, you'd be way up there. I don't want it to go that high because I'm afraid that'll really push us off the cliff into a recession. But these companies can do quite well if oil stays in the $100 range. And I don't see anything going to bring it down very much. So
I was actually going to ask you about the comments that OPEC and OPEC Plus, their oil ministers, have come out with admitting that they don't have spare capacity. We've actually seen that in the data. Josh Young over at Bison Interest, we were discussing him before this. His research, he was tracking this for the last 12 months. He was showing that OPEC Plus was missing their production quota targets. They were raising their production quota targets and then missing them by larger and larger margins.
Yeah, it's been 7 months in a row they haven't made their publicly announced quotas, and I think in May, it may just be an estimate. I think the May they missed it by 2 million barrels a day.
Over 2 million.
Over 2 million because Libya, the situation in Libya. So what that does for us, that then we're exposed as a nation to so much more geopolitical risk. I mean, if this thing in Libya just doesn't get solved. What if Iran gets more, active over there and causes more problems in the Middle East? We're still very dependent. The global oil market is still very dependent on OPEC, and any of that production gets taken out. And 2/3 of the OPEC nations are on steady decline. They have not been investing in their exploration and production either. So they've rolled over. So yes, Saudi Arabia, if they drill a lot more wells, or UAE, maybe Iraq has got some upside, Kuwait a little bit, but the other 8 or 9 countries in the cartel, they're on decline. So
also, even though Russia is making a pretty good amount of profit selling oil not to the US and not to the Western countries like Germany and other Western European countries, Russia and a lot of experts are predicting this now over the next year or two. They're probably going to have an oil production decline of 1 to 2 million barrels per day. So there's a lot of oil experts out there that are predicting a pretty big decline in Russian oil production that the market is not pricing in yet either.
Yeah, I don't really understand what Putin thought he was going to get out of this. I mean, they're still selling quite a bit of oil. Their actual sales may be down like 1 million barrels a day, but they're selling that oil as a deep discount. And India is taking all they can get.
China too, yeah.
Yeah, and China, and they're paying like 60 or 70 cents on the dollar for what everybody else is paying 100 something for. So, frankly, why aren't we sanctioning India? I don't get that.
I don't understand any of these energy policies. I mean, they're so bad, they're intentional. They're just stupid, though.
Yeah. It doesn't make what they're doing. Yeah, it doesn't make any sense. And actually, these sanctions that Europe is putting on Russia is probably going to hurt Europe more than it's going to hurt Russia.
Unfortunately. So where will the oil production growth come from in the years to come then if OPEC, OPEC Plus, Russia are struggling with their oil production growth?
Well, I looked at the last IEA report. That's the International Energy Agency based in Paris. And they're counting on the U.S. snapping back, but I don't see it. And I tell you what I'm hearing from a lot of these CEOs that I talk to is they're worried about tubular supply. First of all the really, really good drilling rigs are already back at work. It takes very big, sophisticated drilling rigs to drill these big horizontal wells. You know, they go down a mile and a half, and then they go sideways for 2 miles. And that takes a big, sophisticated rig, and those are working. And there isn't enough, so many people during the pandemic that lost their jobs. They got other jobs. Now they'll eventually come back because the pay is so high in the oil field, but it's not going to snap back. This was not a short-term thing. They were really under the pressure for 2 years. And so it's going to take a while to get the oil field services and everybody up to snuff. So I don't see that happening. So yeah, is there, upside in South America? And there's some, but nothing near term that I see that's going to solve the problem.
So when I look at where the oil production growth can come from, it's either in the US, it's deep water, or it's Canada. And that's about it, because there's not a lot of reinvestment from a lot of these other countries. I think Brazil and Petrobras are doing some reinvestments and growth, but most of these other large national oil companies are not, and they're actually having pretty large net declines of their production.
Yeah. I heard today that the Biden administration is thinking about banning all offshore drilling. If they do that,
he wants $10 a gallon gasoline.
I guess he wants $10 gasoline.
He slipped up in a speech, I think about 6 weeks ago, and he actually said it in one of the speeches. It wasn't covered in the mainstream media, and he admitted that he wants much higher gasoline prices. So the mainstream media just covered it up for him.
Man, it's going to get rugged if that happens.
So are we actually seeing any evidence then of large scale demand destruction yet because of high gasoline, high diesel, or high jet fuel prices?
No, demand for diesel is definitely there. Is it going down? Because I go back and forth between Houston and Dallas quite a bit, and I can tell you, I've never seen the truck traffic as heavy it is. This guy I talked to in California said, he says the same way. The truck traffic, 18-wheeler traffic out there is super high. Jet fuel demand is coming back. Diesel is like 24% below. Inventories are that low below normal for this time of year. So I don't see that going. Now, for individual people on gasoline, yeah, we're probably getting close. I would think if the national averages goes to $6, you could start seeing some demand destruction. But it's got to happen. I mean, our gasoline inventories are falling too. We just don't have enough refining capacity to keep up with the demand we have because we haven't built any new refineries in decades.
And the Biden administration is going after gasoline station owners who only make a penny or two per gallon in gasoline. If you talk to a gasoline station owner and ask them where they make their profits, it's not from selling gasoline. It's from the car washes or the convenience store sales or from auto mechanic repairs that are attached to the gasoline station.
Well, I'm sure a lot of your listeners know that Hess had like 1,600 gas stations up and down the East Coast. And I can tell you, you're 100% right. They don't make their money off the gasoline sales. They make more money off selling you a big Coke or a pack of cigarettes than they do off the gasoline purchase.
But you have the Biden administration just making gasoline station owners look evil, making oil companies look evil. Look at the statements that the Chevron CEO had to come out saying, you're vilifying our industry. You're not helping things. They're vilifying oil refiners. Meanwhile, it's all the rules, regulations, red tape, bureaucracy, bad policy that's handicapping the oil and natural gas industry from helping solve the problem, the free market and capitalism, and giving the consumer lower prices.
Yeah, if they would just get out of the way. The problem we're going to have on the natural gas side is they ban every pipeline. You can't build a pipeline, or if you do, it costs you 3 or 4 times more than it should because of the regulations and everybody's suing you along the right of way. I don't know. I don't know what we're thinking, but we've got a man-made energy crisis. It's going to get worse. There's going to be rolling blackouts in some of these places. We've also not kept up on our power grid. All this talk about we should all go out and, buy an electric car. I could tell you if we did, it would totally crush our power grid. There's no way we could do that. And there's not enough materials to build them. So yeah, this vilifying of the industry, it just makes me sick. And I just look at it. I think they're just the climate change or green energy wackos, and they won't listen to anything. You can't even have a discussion with somebody that's on that side of the fence because they're so close-minded, and they just think that oil, gas, and coal and everything is so terrible, even though that is the primary energy sources that has made our standard of living so great in America.
And the U.S. can't have you can't have a modern economy anywhere, but especially the U.S. because our infrastructure, our public transportation are not good. We have to have cheap energy. So you have to have cheap energy to have a modern economy, especially for the U.S. And they're trying to force gasoline and diesel prices higher. They're forcing shortages. Aren't natural gas inventories? Aren't we at 5-year lows? So
yeah, we're 300 BCF below, more than 300 BCF below where we should be this time of the year. All of the projections is we are going to start the next winter heating season with anywhere from 3.3 to 3.5 TCF in storage. We need 3.8 TCF in storage to make it through a cold winter. Now, we'll be okay. We're not in the same shape that Germany is, but it's going to be tight. And I could tell you, there's no way we can't keep LNG exports maxed out and refill storage. We can't do both. So this Freeport, Texas LNG facility that had the explosion is going to be shut down for 3 or 4 months. That took 2 BCF of demand off the market. They were exporting 2 billion cubic feet a day out of that facility, one of the largest LNG export facilities. And so that gas can go to storage, but that's not enough. We're still going to start the winter significantly below where we usually start winter. And all it'll take is one cold wave, and you will see the utilities bidding against each other and bidding against the LNG exporters. And they can't match the LNG exporters. The LNG exporters could pay $20 an MCF today, and they still have a huge profit margin. So they're just going to be bidding against each other. And I've seen those bidding wars. When I worked at Hess on one really cold winter, we sold natural gas into the New York market for $60 an MMBTU. So it can happen on a cold wave.
So what this means for the average everyday American retail investor listening to this podcast right now is that their electricity bill, their utility bills, they're going to go up a lot in the next 6, 12, 18 months because of the higher natural gas prices. I don't think those are priced in yet to people's electricity bills here in the United States.
Yeah, the utility companies have to go through these, rate making meetings or some plans or whatever. They have to get rate raises approved. And so you won't really see it, maybe not until this winter, but you're going to start seeing it because I've heard that in Europe they're starting to pass these higher costs because they said the utility companies are all going to go bankrupt if they don't. So, I mean, just think about what if your home heating bill goes up 300 or 400%? That could be a really big deal. And I don't know, in this blame game of blaming it on the companies that are trying to solve the problem, it's just insane. Look in the mirror, guys. You're the ones that created this. Oh, well. Live and learn, right?
And speaking of bad policies, and this is being discussed in Congress, but if the November elections, if things go the way they're looking on predict.org with who wins the elections, this might not happen. But do you think that windfall profits taxes on U.S. oil and natural gas producers, like what is being discussed by the Biden administration and Congress, is that likely?
If it's likely it's going to be passed on to consumers, it has to be. They might do it just for political reasons, but the upstream companies will absorb it. They'll just pass it on to consumers. The thing is, they think, well, we'll just tax the mean old corporations. Well, mean old corporations have to pass on their cost to consumers somehow. And so eventually that just goes in the cost of the energy they're going to supply, and they'll live with it. But I will tell you, it was a disaster. Back in 1980, I was in Tulsa. I had a master's degree from master's in taxation from University of Tulsa. I became a windfall profit tax expert. That's why Hess hired me originally. We battled them in tax court for literally 5 years. we went in and ended up getting over $160 million refund, but we paid in $1 billion of tax during that time period. But it was some of the best years in the history of companies. So it's not going to be really devastating to these companies. I hope they don't pass it. They shouldn't do that. You tax something. Here's the thing. There's a general rule. You tax something, you're going to get less of it. So,
well, if they do pass this tax before the November elections, it'll probably be repealed. But I mean, the odds of that getting through the Senate are very, very low at this point.
Yeah, I don't even think this rebate on the gasoline taxes is going to get approved. I don't think Congress is going to approve that, because that could actually really backfire on them. I'll tell you this: we need higher prices. We need to ratchet back demand. And if by making gasoline even just a little bit cheaper, maybe the perception is people keep driving more than they should or something, or more, and that will make the problem worse. It'll, on the demand side, will get that 18 cents back immediately.
And they're in countries like Japan. I think they also did this in Canada and Quebec. And I think California was even discussing this, and other states are discussing this too. They're talking about handing debit cards or some type of stimulus or rebate check to people for gasoline so they can go and afford more gasoline. But that's not going to fix the supply problems that the governments, politicians, bureaucrats, regulators are sabotaging with oil and gas companies and refiners and pipeline companies.
Yeah. And I'm all for paying less tax. Fine.
Oh, me too.
Lower the taxes. I'm all for it, man. Anything I can not pay tax on would be fine. But I'm just saying it's not going to solve the supply and demand problem. And the only way you do that is you are a bit more friendly to the people that can really solve the problem. And this industry can do it. They're hard workers. They can get out. There's still a lot of oil and gas to be recovered in this country. The Permian Basin is the largest gas field in the world. Our largest oil field in the world, and gas and natural gas. The Eagle Ford natural gas hasn't even been tapped hardly at all. So we just need infrastructure. The problem on the gas side, natural gas side, and natural gas liquids like propane side is infrastructure. You can't pump natural gas into trucks and haul it. You have to be able to hook it up to pipelines, and they're not letting us build them.
And also earlier in the interview, you mentioned there was tubular problems. For listeners who are not familiar, that's kind of industry jargon. You're talking about the steel pipes that these oil service companies, the oil and natural gas drillers use to complete wells, right?
Right. So after they drill the wells, they have to line them with casing. So let's say the well goes down 1 mile and over 2 miles. That's 3 miles of steel casing. And this isn't really cheap, thin. This isn't like the plastic pipe you put in your house or something. This is heavy steel piping. And then inside the casing, they have to run tubing. And that's a smaller pipe. And then they set that in place. They cement that in place, and they frack. They frack through that. They blow holes into the casing and the tubing, and they pump in all that frack sand. And the frack sand's a problem. Those big wells use 100 train cars full of sand. They're completed with that much sand. And horizontal drilling and fracking has saved America, has saved the world from a bigger energy crisis. So there's a lot out there, but it's not cheap oil anymore.
The oil service companies are looking interesting to me because there's going to be more demand for drilling, because these larger oil companies, they need to replace reserves. They have free cash flow.
Right.
In past cycles, bull cycles, where the oil industry actually had profits and free cash flow, they either paid dividends, they either did share buybacks, they reinvested it into more drilling, or they went and did mergers and acquisitions. Those are the four main options. So I think we're going to see, we've already seen the dividend increases and the share buybacks. We're probably going to see the other two with more drilling and more mergers and acquisitions soon.
Yeah, we are. And the oil field service companies, they need to make a profit too. They've been, sucking it up as much as they could just to stay in business. And, Halliburton, Schlumberger, these guys are gonna do real well. And rig rates are going up, definitely. The drilling companies are really good drilling companies. There's only really like 5 or 6 decent sized drilling companies around, and
a lot of them went bankrupt, right?
Yeah, a lot of them went bankrupt. So yeah, but the ones that are still around, they're doing really well.
Yeah, a lot of them went bankrupt like 2017, 18, 19, and 2020 was like the death blow. And then in 2020, like the larger ones, they had to cut their fees enormously because prices were falling. They had to cut their fees just to get any type of revenue to survive. And now they have pricing power. They can start raising their prices.
Yeah, they're going to raise, and the upstream companies know they have to share the profits with them. So, the Helmerich and Payne, they're real good. Patterson, Neighbors, they're really good, high quality companies, and they always survive and they always gain market share in these because it's the little guys that go out of business.
What was the first one that you mentioned?
Helmerich and Payne.
Okay. And those are all publicly traded?
Yeah. Helmerich and Payne, Neighbors, and Patterson.
So which companies that you cover in your Sweet 16 and your energy newsletter, which oil companies that you cover in your paid newsletter have been raising dividends lately?
Oh, a lot of them. I've moved Devon, Coterra. I've moved Diamondback, and who else? What's the other one? Those three for sure are the upstream. I've moved them to our high yield income portfolio because their dividend yields like 12% now. Also paying dividends. Continental pays. EOG pays a big dividend now. And I'll tell your listeners, when you look these things up on like Yahoo Finance or something, when you look at their dividend yield on there, all they're shown is their fixed dividend. These companies pay fixed plus variable dividends. So they may pay, 50 cents a share dividend fixed, and then they pay a high percentage of their free cash flow. So they may be paying out 40 or 50% of their free cash flow, and those dividends could be $2 or $3 a quarter. So I think the last dividend that Pioneer paid was like $12 for the quarter. So, there's some really good ones in there.
In your opinion, can these dividend hikes continue even if there's a correction in oil and natural gas prices that lasts, say, another 3, 4, 5, 6 months?
Yeah, they're variable dividends, so they would go down if their cash flow goes down. But some of these guys got pretty decent hedging programs, so they would be locked in for quite some time. Oh, another one is PDC Energy. They're the number one, maybe number 2 producer in Colorado in the DJ Basin, and they have announced a big dividend program too.
Are there any of the companies you cover you think where it's more likely that they're an acquisition target in the near future?
Well, Continental is definitely an acquisition target now. I think Harold Hamm's bid is too low. I think somebody else is going to come and top that bid. He bid $70 a share. My valuation is $107 a share. 117. I'm sorry. And I saw Truist Financial. They wrote an article like the next day or published that their valuation was $95 a share. So there are a lot of these are. Because of their outstanding cash flow, that makes them tremendous takeover targets, and it just takes one company putting them in play.
And because of the cash flow and the free cash flow, if you're an acquiring company, a larger company, use a little bit of debt. That cash flow will pay back the debt very quickly.
Yeah, I've seen quite a few of these. They're using like half cash and half debt, or half equity. So this one for Centennial mergers with Colgate, I think that's what they did. They're paying them like $500-600 million in cash and the rest in stock, and they're free to. That's how you can bridge the gap a little bit between what the seller and the buyer agree on, and then some of them are done where the cash price is flexible. It says like, if the oil price stays over 100 all next year, you get another 10 million, or, if it stays over 90, you get another 5 million. There's clauses in these acquisition things that are a little bit flexible with the price.
And just in the last week, Dan, there's been about $9 billion in natural gas deals here in the United States. So these are either natural gas infrastructure companies or natural gas producers. So there's some big bids coming in. And then we also just had in the last week, we had another big partnership deal between Chevron and Cheniere Energy, which is LNG, liquefied natural gas on the New York Stock Exchange, for a big LNG export deal.
Yeah, did you see Cheniere announced that they're going to move forward with increasing their export capacity? I just saw that today, that final decision made. I think they've been already working on it, but they just got it fully approved today or yesterday or something.
Well, there's supposed to be a big supply shortage based on demand projections for liquefied natural gas because of demand in Asia and the European Union through at least 2026. So I think liquefied natural gas exporters here in the United States, we're the main liquefied natural gas exporter outside of OPEC countries like Qatar and some of the other OPEC countries.
Yeah. Everybody, even the Green New Deal people, should be supporting natural gas like crazy. The fastest way to reduce carbon emissions is to build more natural gas fired power plants and less coal fired plants, and shut down coal fired plants. And the really, really best way is to build more nuclear power plants, but there's no political support for building nuclear power plants. And it's just amazing to me.
Well, here in the West, yeah. So you have France and Germany and other European Union countries. They're shutting down their nuclear power plants. They're either phasing them out or shutting them down. I think Japan may be restarting more of their nuclear power plants, but they don't really have a choice because their energy input costs are up so much. But the only nuclear power plant growth, I think, is in China, Asia, and Saudi Arabia.
Crazy. And think about it. In Saudi Arabia, where they have massive natural gas and stuff, they're building nuclear power plants because they want to export the oil and gas. That's why.
Yeah, I mean, it makes a lot of sense to export something at a higher price. So if the U.S. is going to export liquefied natural gas, that to me, it guarantees much higher domestic natural gas prices. So if we're going to export more of it at a higher price, if our companies are going to make a profit, the domestic price is going to have to be higher. And especially because our utilities here in the United States, our electrical utilities already switched in the last 6 or 7 years over from coal to natural gas already.
Well, I will tell you, I went to a energy conference in Houston at the University of Houston. And at lunch, I sat next to this guy from IPAA. That's a big industry, organization. And that we were just starting to export LNG then, just talking about increasing exports and becoming a net exporter. Up until then, we had been a net importer. And he said at the table to everybody, he said, once we're exporting 10% of our natural gas, our gas price will move closer to the global price of gas. Well, we're now exporting, when you take 8 BCF a day pipeline export capacity and say 12, 13 BCF a day of when Freeport comes back online of LNG export capacity. So we're at like 20% because our total gas market is like 95 to 97 BCF a day. So we're at like 20 now. So you're going to see the age of cheap gas, natural gas in the United States is over. I believe that we will not see gas go down back to $3 or anything close to that. And I think there's a much better chance we start seeing a floor price of maybe like $5, even when things get kind of back to normal. $5 or $6 gas will be our regular gas price. And then we're going to keep layering on more LNG. I heard if all these things get built by 2077 or 28 or something like that, we're going to be up to like 23 BCF a day of LNG export capacity.
Yeah, you have Tellurian, which is building the phase 1 of their construction project. So, and then you have a bunch of others that are potentially going to come online by 2025, right. 2026, maybe 2028, somewhere in that window between like 2025 and 2029 or 2030.
Yeah, demand for U.S. natural gas, both domestically and for export, is growing at a rate about 3 or 4 times as fast as global demand for oil. So global demand for oil goes up maybe 1.5% a year. Demand for just U.S. gas is going up by like 4 or 5% per year.
Well, did you see the number that came out for global electricity demand? It actually grew by 6% globally last year in 2021. Wow. Because a lot of these utilities were switching from coal to natural gas, and also because more people were using electrical devices, electric vehicles. They were staying at home, using electronics, staying online, and then plugging in more appliances, electronics, and electric vehicles.
The one thing with all this electrical vehicle stuff and everything is people don't realize we don't have the materials to come close to these projections on how many electric cars are going to be built. We would have to really beef up the power grid. It takes 3 or 4 times as much copper inside of a Tesla as it does inside of a regular internal combustion car. Where is all the copper and nickel and even steel and everything to build all this stuff? The concrete to build all the wind farms and stuff. I just don't see it. The increase in mining activity. And, if you're a person that likes the environment, go visit an open pit mine sometime and see how much you like that environment. I can't even
these electric vehicles also use a lot of rare earth elements, and to mine rare earths, to separate them in the value chain, you're using enormous amounts of toxic chemicals. So the air, water, and soil around a rare earths mine, the separation facilities, I mean, all that area is like almost a radioactive fallout zone. It's very, very toxic.
I know there's nothing green about this green energy proposal. Let me tell you, there's nothing green about it at all. Yeah, maybe the end thing is if the electricity is free, but it takes a lot of materials. It takes a lot of diesel. Think about this. Think about how much diesel it takes to haul those windmills out there, to construct them. All that takes a whole bunch of petroleum products. So, when you hear Joe Biden tell somebody at a rally that he's going to totally eliminate fossil fuels, that's the biggest lie that's ever been told. I mean, he either absolutely is ignorant of the industry, or nobody's telling him, nobody's putting on his cue card or something. But that is just a total lie.
Well, unfortunately, a lot of adults don't understand how electricity is generated and where it comes from. So they just want the electricity available when they plug their appliance or electronics into the socket.
Yeah, and I can tell you, half the world doesn't have reliable electricity. So, and they want to live like we do.
So I have a couple more questions before I let you go. So why do you think big name investors, and a lot of these guys are traditional value investors, normally people who would not buy oil and natural gas companies or oil pipeline companies or base metal miners like Warren Buffett, who just announced recently he added even more Occidental Petroleum shares, I think another 10 billion to an already large position. He has an enormous position in Chevron. Stanley Druckenmiller, he's adding oil and natural gas stocks, and traditional value investor hedge fund manager David Einhorn and traditional value investors don't buy commodity companies. David Einhorn disclosed enormous positions in oil pipeline companies with large dividends, in oil and natural gas producer, I think Southwestern Energy and some others. Why, in your opinion, have they been accumulating a lot of large cap oil and natural gas shares lately?
Well, I think they're going to take Oxy private. I think he's going to buy it all and take it private. So we'll see. But they should be. This is where the money's going to be made for the next few years for sure. And there's a lot of cash flow coming. And, a lot of money has rolled into, like I said, our Sweet 16 was up 132% last year. Even though it's pulled back recently, we're still up about 40 or 50% in the portfolio this year. And I think this is just a temporary point. I think this is fear of the Fed now. But, this ESG stuff has scared a lot of people away from it. The Wall Street gang was told not to invest in or loan any more money to these companies and stuff like that. And, that scares people that aren't real familiar with the industry, but it's got to come back, or America as we know it is going to change forever. And it's not going to be a good change.
It's been a nice little pullback in Occidental Petroleum. It's down below $60 a share, but their dividend is still their trailing 12-month dividend is still low, but the company is it's robust now, the earnings.
Yeah, you got to look at these companies and look at their variable dividend programs that they've announced. They're really, really good. And I tell you, another thing that I like in the public is the minerals companies. There's several publicly traded minerals companies, and all they own is that. So they don't pay for the cost of drilling or completing of any wells. They actually own the minerals for, they're not leases that expire. They lease their minerals to the upstream companies, and then they keep a royalty interest. And
so these are oil and natural gas royalty companies?
They're royalty companies. The one of the largest ones I like is Viper. It was spun out of Diamondback Energy. Its symbol is VNOM, Venom. Another one, and now these are the C corps. A kind of a smaller one, but I really like it, is Brigham Minerals, MNRL. I really like that one because they're unhedged. So, and they pay out like 70% of their free cash flow as monthly dividends. One that's exposed to natural gas is Blackstone Minerals, BSM. It is an MLP, though. So I know some people don't like MLPs, but those three are really good, and they pay really nice dividends. They're double-digit dividend payers.
So for an oil and natural gas royalty company, then for their cash flow, does it mean that there has to be more and more drilling, or are they going to get a minimum amount of cash flow if drilling is low?
No, so they own the mineral. Now, what increases their revenue stream is when somebody goes out and drills on their minerals. So if they, own, 40 acres in a 640-acre block, and somebody drills within that unit, they're going to get a share of those royalties. They get a share of that, just that revenue, and they don't pay anything but production taxes. That's the only thing their expense is. So they have very low overhead. It's just their G&A, back office overhead, and the cost of being public. But if you look at their income statements, pull up Vent, and they're real easy to understand because they're very simple structures. The thing that I like about Viper is that most of their minerals are being drilled up by Diamondback. And Diamondback is one of the most aggressive drillers with like 20 rigs out in the Permian Basin. And a lot of the wells they drill are on Viper's minerals. So they're constantly ramping up. And they had a lot of their production hedged last year. This year, their hedge book is much less. And so they're going to be getting really good prices going forward.
So the last question before I let you go, because we're over 50 minutes now.
Yeah.
Can U.S. natural gas producers make a lot of free cash flow and good profit margins with the U.S. natural gas prices around $6 right now?
Oh, yeah, a lot. I was looking at Antero, and they're going to generate like $3 billion in free cash flow this year.
And is that a small cap Antero? So that's an enormous amount?
That's an enormous amount of money. Let's see. Okay, that stock on January 1st of 2021 was $5.45, and now it's over $30. So if you invested in it a year and 18 months ago, you're up like 500%. They're up like 90% this year.
And they're throwing off big dividends too.
And now they have not started paying dividends. They did have to pay off a lot of debt. I thought they were going to go bankrupt at the beginning of the pandemic, but they gutted it up, and they really, really have cleaned up their balance sheet. So they will stay. They mentioned on their last conference call that they were going to start paying dividends pretty soon. So
I would say, Dan, that in hindsight, the pandemic was actually like the end of the natural gas bear market in the U.S. and the start of a brand new bull market here in the U.S. because it took so much supply offline that was like the final washout. So natural gas companies had been struggling for years because of all the shale gas byproduct. There was too much supply. Natural gas prices couldn't stay high. There used to be an options trader, and all this guy did for years, enormous profits, was just bet natural gas was going lower and do options trade shorting it. And for years that was profitable. Eventually that wasn't going to last though, because you can't keep growing supply and losing money.
Right. See, I think what happened, natural gas pulled back from like $9 to $6 because of this Freeport thing. I think a bunch of the paper traders, speculative traders, they got killed on that first announcement of the Freeport explosion. And then at first they said their plant was only going to be down for a couple of weeks. And
Margin
then
calls.
then they got double whacked when the company announced it was going to be down for at least 90 days. And I think those guys are out of the market. I think they got margin called out. And so I think this pullback to $6 is, for one thing, I think when Freeport comes back online, if they come back online in 90 days, that's at the beginning of the fourth quarter, just when you're getting ready for the home heating oil season. So I see a big rally in natural gas into the end of the year.
I don't know about the short term for natural gas, but I'm looking at the investing activities for a lot of these natural gas companies. Oh, yeah. And if the natural gas prices do go lower, the larger natural gas companies that have had enormous free cash flow and low costs, they're being very aggressive here. Just in the last week, $9 billion in deals and additional liquefied natural gas deals, large ones announced. And then you have the European Union, Germany, and other European Union countries. They're scrambling to lock in 10-year liquefied natural gas contracts with U.S. firms and firms in Qatar and OPEC.
Yeah, take a look at Comstock Energy. It's 99% of their production is natural gas. The company is controlled by Jerry Jones, the owner of the Dallas Cowboys. He owns like 75% of the stock. But if gas stays at $6, if gas stays at $4, the stock's a steal. I mean, they are trading way below any reasonable valuation. And they're a Haynesville company. Haynesville is in East Texas and Louisiana, and they are very close to the Henry Hub, where there's 12 or 14 different pipelines they can sell their gas into. They have absolutely no trouble getting their gas to market, and they're working on direct sale deals to the LNG exporters. And so they could start getting premium prices for their gas. It's a real interesting company.
Well, you've given my listeners a lot of interesting companies to do some research on. Again, for people who listen to this podcast, don't go out and buy everything at once. There's always the possibility of a correction. It's a common mistake for retail investors that they hear something on a podcast and they go out and buy all the shares of a company at once. It's a big mistake. Professionals don't do it. In the short term, we might have lower oil and natural gas prices, but I think there's a lot of evidence here, especially with the investing activities from big name investors and these larger low cost oil and natural gas companies that have paid off their debt. I think there's going to be a lot of mergers and acquisitions of small and medium sized companies going forward, especially if free cash flow continues, because they're going to want to pay dividends, they're going to want to buy back shares, and then they're going to invest in drilling and mergers and acquisitions.
Yeah. And if any of your listeners want to become EPG members, just have them, they can contact us just at energyprospectus@gmail.com. That's Energy Prospectus, one word. You can just Google Energy Prospectus Group and you can find us. And it's $350 a year to be a subscriber, and you get our newsletter. We have webinars, had one today that we have energy sector specialists on there. We also have CEOs of these public companies on the webinars with us, and we publish detailed reports. In addition to a newsletter with 3 model portfolios, we publish quarterly reports on about 40 different companies per quarter. So a lot of good information and a lot of good forecast models you can use.
And you also have in-person conferences or luncheons where some of these oil and natural gas CEOs come and speak and present. Although I don't think you've had Jerry Jones come and present, because then I think like a lot of your Cowboys fans would be very angry with what he's done with the personnel decisions with the team.
I know. I've tried several times. I actually know the guy that's an investor relations manager for him. I can't get him to pay for anything. I'm not doing luncheons up in Dallas anymore, but we are doing lunches down in Houston occasionally. We just had one a couple of weeks ago. I've actually got 3 metals companies have paid for luncheons, but they haven't picked a date. But the metal side looks pretty interesting to us too. And we're not against anything. I'm not against wind and solar. I just don't think that's where you're going to make the money. I stick with what I know, which is the upstream companies the most.
Well, even if wind and solar do get a lot of funding, I mean, the amount of copper that's going to be used, so there's still going to be metal needed or other types of materials needed to build these enormous wind turbines or solar panels. I mean, the solar panels use an enormous amount of silver and rare earth elements and other materials.
Yeah, I do have one copper company is in our growth portfolio, small cap growth portfolio. It's New York Stock Exchange. It's Aero Copper, ERO is the name of it. And the stock has really pulled back recently to a real good entry point. And it's profitable. This is an existing mining company selling tons and tons of copper. It's got 2 mines down in Brazil. So, one
of my friends runs a gold company, and they have investments in a lot of copper mines. They buy the gold and silver byproduct for royalties and streams, and he thinks that copper over the next 10 years, because there's a lot of old copper mines that are coming offline, and demand for copper is growing enormously with electric vehicles, electrification. He thinks copper could be $10 a pound in 10 years or less.
Yeah, it's like 380 or something today. Look,
it's pulled back.
It's pulled back recently because of all this worry about a global recession. Because it's it's considered kind of an old industrial metal, but it's absolutely critical for electric vehicles. There's probably more copper is going to be in an electric vehicle than lithium. And I talked to the CEO of that company, and I asked him, I said, "Guy, is there enough copper in the world for all this stuff?" And he said, "Not known reserves, that's for sure." And so these companies that these smaller cap companies are takeover targets from the bigger mining companies all the time.
Well, Dan, I really enjoyed our discussion today. I want to thank you so much for your time. And you already told my listeners how they can take a look at your Energy Prospectus Group newsletter.
Yeah, thanks a lot.